Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. You know, one of the conversations I know you're having is a talk of a possible recession. It continues, and author Mark Tepper, he believes unfortunately, one is on the way.
Consensus seems to believe right now that there's less than a 50% chance of a recession, that it would be next year, that it would be short and shallow. I disagree with all those things. I think the recession is going to be longer and deeper than most people believe, and I think that means we got to take our medicine.
What does he mean, Art Luke? Take our medicine?
Take your medicine, meaning with the stock market, with the Fed, with interest rates. I did a video that I sent out to clients last week in regards to what we see from a recessionary standpoint, what our indicators are. You know, one of the things that I mentioned is, you know, during March of 2020, when COVID first hit, the Fed was on our side, right? The Fed was pumping up the markets with liquidity. Well, now they're doing the opposite. So when we said back in 2020, don't fight the Fed, it's time to buy back into the market. Well, now, don't fight the Fed, because the Fed's going the opposite direction. Now, of course, the market can change at any time. The market is not necessarily the recessionary indicator. That would be more on the unemployment, you know, layoffs, losing jobs, things like that. But we see something on the horizon for sure.
Yeah, and we have kind of a perfect storm right now when inflation is as high as it is. The Fed has to continue raising rates, and they're doing it right now while the economy has been really good. But when you have interest rates on home loans going from last year being in 2.75 to 3% range to 5.5% as we speak now, that's going to start making changes pretty dramatically. You're seeing that across the board. And the Fed has to continue to rise as long as inflation is sitting there. And as inflation continues to rise, so will interest rates. We are hoping, you know, sometime through the summer that inflation has peaked out, but you never know, you know, so we'll have to see what happens. But I think if we can peak out on inflation, then that'll begin a story of where we'll get some buy signals. But right now, everything has been pretty nasty on the bond market side and the stock market side. So it's been a bumpy ride for sure.
Yeah, so a quick funny story. A couple of months ago, I was talking about my dad retiring, trying to get him to move to Florida. He's not to Florida yet. He's still in Kansas City. But he picked up a part-time job at a grocery store, and he's stocking the shelves and changing the price labels. And he says every week, every time he goes into work, what's he doing? He's raising prices on everything.
No way.
So that is just coming across the board. I mean, now you have to think with Walmart's bad earnings, they're raising prices. Target had bad earnings, they are raising prices. So the Fed has to continue ratcheting and tightening and fighting inflation.
We're looking at data, Luke. Wasn't it like a miss on the quarter? They had $250 million more in expenses than they expected from shipping.
Yeah, from Walmart. Yeah, from freight. So if you run that out for the full year, if that continues, about $1 billion more expense for Walmart.
Why is that? Why you would think at a time like this, you know, Walmart and Target, they would have higher than expected earnings because people aren't spending going to the heavy costs. They're kind of sticking in the discounted stores. Why the low earnings?
There's more volume, but there's more cost. So what happens is your net dollar for the company has been reduced because the costs have gone up so dramatically. So what they're going to have to do is they're not going to eat those costs. They're going to pass those through to the end user, which is us. So what happens is they will be raising those costs more, which is more inflation, which is more inflationary.
Yeah, so they ate them a little bit for the first quarter. We don't know how much they ate, but they're not going to do that anymore.
Right.
I wouldn't.
I was
you won't become a viable business if you do.
Right.
I was at Big Lots a couple of weeks ago, and I noticed they had all this Christmas stuff out. I was like, my goodness, man, we're barely into spring. Like, I know you want to get a jump on it. And I just said, just kind of offhand, it was like, hey, man, a little early for Christmas. And the guy goes, no. This is all the stuff from 2021. It just got off the ship. And we have nowhere to put it. So we're having to put Christmas stuff from last season out because of all the supply chain issues. Like, wow, I mean, heavily discounted stuff.
So Christmas 2022 is Christmas of 2021.
Pretty much.
Don't tell our wives.
So get your 22 Christmas tree now.
Yeah, don't tell our wives.
Don't tell Julie. We have already 7 Christmas trees. I don't need an 8th.
Oh my gosh, she's going to hear this and get all excited.
Oh boy, here we go.
So the question is, you have an income. Do you have that income to sustain the ups and downs of economic inflation? Let Art McPherson, let Luke McCarty take a look at your portfolio to make sure these economic shifts don't damage your retirement plans. If you have that $500,000 in assets spread across a 401k, an IRA, a Roth, maybe a savings plan, give the team a call and take advantage of the complimentary consultation. 321-425-8550. Good for the next 5 callers this weekend here on The Art of Money to sit down with Art, to sit down with Luke, to personally build or take a look at your portfolio. So amid all this turmoil the markets are experiencing, one article says the move into bearish territory could present an opportunity for a Roth conversion. So Luke, Art, what are the benefits and why is it so attractive right now?
Yeah, now is a really good time to do a Roth conversion, to have the analysis ran. Mark here in our office, the CPA, he runs an analysis for our clients. But right now, from the stock perspective, you're getting a 20 to 30% discount than you would have if you did the same Roth conversion in December. So the Roth conversion, right, you're taking IRA dollars, you're converting them to the Roth. But what we can do is we can convert shares of stock that you currently own. So you're able to get more shares over to the Roth today than you were in December. The same dollar value, but more shares. And then when the market recovers, like it always does over time, you'd get that recovery tax free.
Right. So you're washing money at the lower value than having to wash it at a higher value. So it's a good time to do it. Plus, right now, most analysts and experts agree we're in probably one of the lowest tax brackets we're going to be in over the next 20 or 30 years. Taxes are probably going to be going up. The current code that we're in expires because it's temporary and rolls back to our old tax code. So the 12% becomes 15. The 22 becomes 25, the 24 becomes 28, and so forth and so on. So now's the time to do a lot of these type of conversions because it's very tax efficient. But we go a step further and we want to make sure that whatever percentage tax our client is paying this year, that if we were to convert it this year, that they're never paying a higher rate than they would be when their required RMDs kick in, their required minimum distribution. And we do like some forecasting on rates going back up, where they're going to fall. So we do a really deep dive into that for our clients, making sure that when we do that conversion, it's in their best interest for now and later.
All right, artofmoneyradio.com for more information on the McPherson Financial Group. And gentlemen, later this year, Fidelity says it's going to allow investors to put Bitcoin in a 401k plan that it administers for companies. Now, we don't know how many employers will sign off on this option, but is that a clear signal that the idea of including crypto in a retirement plan is becoming more popular, more mainstream?
I just hope they have severe limits on it.
Right.
I mean, if you had done crypto last year when it was at peak interest, when you have maximum buzz, everybody's happy with it, everything's going great. It had gone from, 10,000 when it really became mainstream to $50,000, $60,000 and everybody, such a huge buzz around it. Everybody's talking about how much money they made in crypto. But guess what? Crypto is now at about 29,000 and we've come off of those highs. And now most everybody in the last year that probably bought in around that buzz period has lost 50% of their money or more. So when you're talking about $1 million to $3 million, which is kind of the average that we're seeing with people that have been saving for 25 or 30 years now walking into our office, I don't want them putting 50% of their money in Bitcoin and now having 400,000 or $1 million that was $2 million a year ago. Mm-hmm. So that can be extremely dangerous. Of course, the allure is we all fall prey to this. I can outperform the market. I'm going to be that guy that makes myself a multimillionaire by buying Bitcoin. And when everything else is going down, I'm going to buy Bitcoin, and Bitcoin is going to go up 100% for me when the market's down 20. That's what we all say. Yeah. But the odds of that happening are slim to none.
I was going to say Bitcoin is actually now more correlated to the stock market than it ever used to be. It used to be kind of, hey, let's buy this cryptocurrency as a hedge, kind of like gold. But now it seems to be going up and down with the market, but a lot more on the down when the market's down, a lot more on the up when the market's up. Mm-hmm. But that's why Bitcoin's down about 50% recently while the market's down, 20 to 30. So, we've been doing a lot of research here with risk within our client portfolios and, how we're going to potentially make changes to the portfolios as this market continues to change. And we're looking at a new trading platform that actually provides a risk number of 1 to 99 on each investment. And then each client would have their own risk number. And my assumption is for Bitcoin, that's going to be up towards the 99 range with, Tesla and innovative technology. But by having those numbers, it's going to allow us to help reduce risk in our portfolios and to help match up the current client's risk tolerance.
If you give a numerical value to something, you say, Bitcoin sounds good, but you show them it's a 99 out of 100 as far as risk. They're like, oh, now I see what you're saying. Oh, I get it.
What is that model, Luke, that you sit down with the client? What is it, like a risk-alized test? Is it
That's correct. That's exactly what it is.
It's risk-alized, but it's also tied into the trading platform. And so it actually helps us determine the risk in our current portfolios. And of course, we do a lot of research on what goes into our portfolios, but this is a different way to look at it. So Art and I are looking into this platform, to see if we want to roll it out in the next month or so.
Yeah, we're doing some beta testing on it.
Luke, let me ask this. Let's say I'm about 50 years old. I have a little bit of money that I want to invest in, and I come to you and I say crypto. What would you say to a 50-year-old?
I'd say be very careful. Most of the crypto coins out there are probably not going to be around in 10 to 15 years, whereas most of the stocks you buy will. Most recently there was something called a stable coin, and I've had a lot of clients, a lot of friends tell me, hey, you can park your money into this crypto wallet and you're getting 10% return on your cash. Well, that's a heck of a lot better than a bank, but one of these stable coins just went bankrupt, went down 99% in a week. So there's, that stable coin wasn't very stable. So if you're 50 in your scenario, Mark, and you're thinking about doing crypto, I would limit it to 5% of your portfolio, maybe 10 if you think you know what you're doing or you're a gambler, but it's very risky.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174. 725.
Today's show has been a work of art.